Good evening, everybody. All right. Hope everybody's having a good winter evening. So we've got the great pleasure of having Scott Andrews with us here tonight. And Scott is probably one of the foremost, I want to say, innovators of using gaps. He, as a matter of fact, he founded Master of the Gap and SciQuest, which he took public. He was CEO. And so anyways, he's got some very interesting perspectives on and statistics on what happens after a gap. So with that, Scott, welcome to the Candlestick Forum. We're anxious to see your information tonight.
Great. Thank you very much, Steve, and appreciate the opportunity to present to your fine folks again. And on this rainy night here in North Carolina, at least, I'm gonna jump right into it. So I am going to share quite a bit of historical research. Everything I do, quite frankly, is research based. Quite a bit different than Steve, and I wish I was as good at interpreting charts as Steve, but I'm not. So I migrated towards using historical analysis, real detailed, robust historical analysis over the years. And I'm going to be sharing quite a bit of research tonight on gaps, trading opening gaps in general, but also on candlestick patterns. Specifically, I have 12 I'll be talking that I learned, quite frankly, from Steve. Steve's book was one of the first books I ever read when I started trading back in 2003. So please use this information at your own risk. I personally conducted and created all this research you're going to see, so I do believe it to be correct. I use it myself. I have updated it recently. Some of it, the candlestick information, I just updated yesterday, so it is accurate to the best of my knowledge. But as always, you want to trust but verify, and always use good money management. And I'm a futures trader primarily. I know many of you trade stocks and equities and ETFs, but with any type of trading, especially futures, when there's so much leverage in play, you need to be especially careful. So please do use this information at your risk. You have a tremendous opportunity. If any of you are new to trading, I'm sure you realize this, but most people overestimate what they can accomplish in a given month or 6 months or even their first year, and underestimate what they can accomplish over a 10-year period. So what that means, and why I mention it here with this risk disclosure, the last thing you want to do is be too aggressive starting out and ruin a potential lifetime of accelerated returns. Some pretty phenomenal things can happen when you start compounding your money. You just have to survive it first. So please be extra cautious. People tell me I tend to inspire confidence because they can see the data that I use, that I personally trade with also, and I just don't want to inspire overconfidence, okay? So with that caveat, let's get into the good stuff. You can download my ebook that we did mention in the promo for tonight's webinar simply by going to investorquant.com/Bigelow. You can also get a copy of all my slides. I've probably got more information than I can completely cover, quite frankly, in about 45 minutes. So I'll be going somewhat quickly through it, but there's a lot of research in here. You can get the slides and the ebook by going to investorquant.com/Bigelow. Oh, thank you, Jim. Appreciate that. Jim's posted the link for you. And honestly, I've never tried that. I think it's called a QR scanner, barcode. Never tried it. I don't know how to try it, but I'm told it works. If you want to go that route, just go straight to the link. I will say if you purchased, that book was sold through Traders Press. They printed 5,000 copies and sold out. And all the research was published in 2008. I've updated all the research as of the end of last year. So it's the most recent 10-year period, and it has probably 20 tables or so breaking down opening gaps and the probabilities of filling or not across a wide range of different criteria and filters. All right, so here's what we're going to cover tonight. I'm going to show you, tell you a little bit more about myself. expand upon Steve's introduction, but trust me, it's not going to be a gloating session by any means. But I do want to point something out. I believe it's very important. I'm going to help you understand the basics of fading the gap. That might be a new term, a new phrase for many of you. I'll explain that to you. It's what I do. I consider myself to be a gap fader, not just a gap trader, but I'm a gap fader. And that's what I've done has been the core of my professional trading for more than a decade. I'll show you the logic I use to select and the process to select and trade gaps. I've got, as I mentioned, 12 slides on candlestick specific research for trading the gap. Answer any and all of your questions. I love questions. In fact, I'll encourage you now to go ahead and ask questions as we go along. If you'll just give me the benefit of the doubt and let me answer the ones that are most appropriate for the slide that I'm on. And if I miss your question, please just reference it with your timestamp at the end, and I'll come back to it. I never, ever intentionally pass on any question, even the tough ones, okay? So I welcome them and happy to answer your questions this evening. Raymond has a question. We're going to go over all three major gaps. You can categorize them however you want. I'm going to be talking primarily about well, I'm just going to tell you how I analyze all types of gaps. I don't really get caught up in the nomenclature. We'll say it that way. All right. So why should you listen to me? Well, as I mentioned, I've been a full-time trader since 2003 when I stepped down from running a public company. And I've educated thousands of traders, hundreds individually. I've done a lot of one-on-one work with traders from all over the world for coming up on a decade. I started educating actually in 2008. I was fortunate to take a company public in 1999, and I'm very proud of the fact that my company, our company, was one of the .coms that actually made it. We survived. The company's still public on NASDAQ. Went to West Point, was an Army officer, helicopter pilot, have a nice house with a huge kitchen, vacation in very expensive places, and my mom thinks I'm incredibly handsome. And I don't disagree with her on that. But as you can tell, I'm extremely qualified, right, to teach you a thing or two about trading. Right? That's a pretty impressive resume. Wrong. It doesn't matter, folks. Okay? Yes, I guess it tells you I'm willing to do a little bit of work and have done a little bit of work in my life. But that does not make me qualified to teach you, frankly, anything of true value as a trader. This is not a game of pure intelligence. This is not a game of that requires enormous education. It does require discipline, and I do have a track record of discipline in my life, though my wife may disagree. This is about doing something that takes a ton of emotional intelligence, not just classic intelligence. It takes a lot of discipline, and I've got a lot of experience in the ways that matter. So there are folks, as you know, in this industry that are not like myself and Steve. They will try to impress you with their impressive resumes, and it just doesn't matter. In fact, frankly, some of the smartest people I've ever worked with were some of the worst traders. So nothing on my resume should lead you to believe that you should trust me. However, I do have one slide I want to share with you that I think is important, and that's my trading history. It's the only thing that matters in my resume per se. And I'm not here to say, well, look what a great trader I am, but I think what this will show you, in fact, let me explain what you're looking at first. This is every trade I have taken, it's over 2,000, as an educator, or since I started educating. I started Master the Gap, which was a blog launched in early September of 2007, and this equity chart starts in September 1st of 2007. 90+% of my trading activity is shown right here. I have had a couple small accounts, an options account with a little bit of money with my kids, some money for my kids, and also had a small account at another small boutique brokerage firm that was for discretionary trading. And I took about $40,000 and turned it into $20,000 as a discretionary chart-based trader. So I am not nearly, and I'm a little better now than I used to be, but I am not skilled like Mr. Bigelow here. It's just not my cup of tea. But what this is for all of my accounts that I've got at my prime brokerage here shows you is, well, a couple things. I did extremely well at the beginning. I was an educator. 2007 in the fall was the peak of the markets before we had the giant meltdown in 2008 and bottomed in 2009. That's what that first run-up is. So my approach, I didn't realize it then, but because I'd never been in a bear market, does extremely well in bearish market and volatile markets. And you can tell even the past year or so, I've had a really good run again. But you see a lot of chop. I'd run up, have a little sideways, and pull back, and went through a couple of back surgeries there in the middle. And I'm not trying to make excuses, but when you do, I will point out, when you have things going on in your life that are taking a lot of your time and distracting you from being all you can be, it doesn't make it any easier to trade. So you want to back away a little bit. Anyhow, I've had lots of drawdowns. That's something a lot of traders don't like to talk about. I've probably endured 20 or so significant drawdowns. That means pulling back in my equity, or my equity from my equity high. So I will hit a new all-time equity high in terms of capital I've made trading, only to go into a drawdown most of the time. So I'm not sitting at equity highs all the time. And a lot of educators lead you to believe that's what you should expect, and that's the way it works. And I guess in theory that's possible. I don't really believe that's, I've worked with, as I mentioned, lots and lots of professional traders of all types over the years, and I've seen my share of equity curves, and quite frankly, even the best ones look pretty choppy like mine. So it's just the nature of the beast. So again, I think what this tells you is I've got a few scars, and from the scars I can teach you a thing or two. So let's talk gap trading, okay? So what is a gap? A lot of ways to define them. For the sake of this presentation, I'm going to define it my way, and it's real simple. It's simply the difference between where a security, right, a stock or ETF or futures contract or commodity contract, where it opens relative to its prior day or prior session closing price. All right, so just the difference between where we open for the regular session of that instrument and where it closes, where it closed the prior session. That shows up visually, right, as a space on a gap. You can look at them on daily charts. You can look at them on intraday charts as well. And in fact, here's an example on a 5-minute chart. So this was actually just a couple of days ago. We closed on the left there, prior day's closing price. Next morning, gaps down, chops around before it actually filled about the middle of the day and went sideways for the most of the day. So this is a chart for the ES. I use a 9:30 a.m. Eastern Time open, New York Stock Exchange open, and the close at 4:15. And can you see my mouse? I just realized I don't know if you can see my mouse when I move my mouse on a screen or not. I'm guessing maybe not. No. Dare I experiment? How about now? Can you see the little marker? Or do I need to draw something on it? Nope. Okay, I bet you see that. Okay, you see, all right. Control bottom left. Oh, okay. So I'll try to do that, maybe point out with this marker from time to time. Let's keep moving. So that's a gap, as I define a gap down. I don't worry about whether it gapped inside or outside the prior day's range or anything like that. It comes into my analysis, but the definition of a gap is simply a variance between where we open versus where we close. So my strategy is to fade the gap. That means to short up gaps and buy down gaps. Not all of them, just the ones that meet my criteria. But the concept is to trade in the opposite direction. And I'm targeting the prior day's closing price, and it just depends on the instrument. If you're trading stocks or ETFs, we'll use a 4 p.m. Stop or target. If you're trading futures, like the equity futures, like I do with the S&P or the NASDAQ, we use 415 to close the CME. And if neither my target nor my stop is hit, then I close it at the end of the regular session, again at these times. There's a question, can this be applied to Forex, the open of the Asian market Sunday evening? Well, yes it can, and I've worked with a few folks that have done that, but you only get pretty much that one gap, right, a week. So I've never really pursued it, don't have any firsthand experience. But conceptually, what I'm going to show you tonight applies in terms of the analytical approach to everything I've ever tested, and that's probably why it's so robust and so utilized by so many traders now. I have a zone methodology, and I'll get to that in a bit. So here's a chart. This is actually, I didn't realize this, but I was talking to the guy in my office, Matt, who's on our marketing team and was helping me out, and he created this slide. This is an actual trade that I took a couple weeks ago, actually. I think it was the 17th. I'm forgetting the date. May have been the 9th. But 2 or 3 weeks ago, there was a big gap down. It was a 25-point gap, or about $2.50 in the spider. It met all my criteria. I took it and nailed it for my biggest win of the year. But the idea here is to buy down gaps. By the way, I have losses too, plenty of them. We'll talk more about those. To buy down gaps or short up gaps, again, targeting a level roughly equal to the prior day's close. That's all it is. So that is probably different than many of you that are looking at gaps on daily charts and using them to swing trade. That's a valid way to do it for sure. In fact, often you will do what I call follow the gap, right? You'll look for breakaway gaps and patterns and trade in that direction for swing trades. Absolutely nothing wrong with that. I found I like to turn my capital more quickly, and I don't like overnight exposure. Just especially with trading futures. So I've migrated to trading more frequently, trading only on the intraday, getting in and out in an hour or two using the leverage, careful leverage of futures. And it's worked extremely well for me for a long time. A lot of ways to make money in the markets, and this is the way I do it. Question is, does your strategy work on SPY, Qs, Russell? Absolutely, Cal. And many folks use my research to do that exactly. I don't trade, I don't trade the Dow personally. I've dabbled with it. I haven't had as much luck, even though it's correlated with the Spider and the Qs and the Russell, but I do trade the corresponding futures markets, the Russell futures and the NASDAQ futures. And they're so correlated with the Qs and Russell and ETF. All the data I'm going to show you tonight is all very, very similar. Question is, does this work on swing trades? It can help you time your entries and your exits on swing trades, yes. But all the analysis I'm going to show you is based upon what's likely to happen on the day of the gap and only that day of the gap. And I'll get to some examples. My research, I'll show you what qualifies as a minimum size gap in just a moment. So there's a question about logic. Why do gaps work? Well, here you go. So basically, the overnight session, like now, and then through the evening with the Asian markets tonight, and then European markets, you'll have economic and geopolitical events anywhere in the world, even here in the U.S., right? I think we've got, I should know this, but I think the monthly jobs report is tomorrow morning, first Friday of each month, coming out at 8:30. That is going to drive some volatility. And the volatility is normally a little bit higher, often higher, because there's less volume in that overnight session. So they cause the market to move overnight from the prior close. 90% of them roughly are large enough to trade. In rough terms, 10 cents in the spider or a point in the ES futures is big enough to trade. I use a sort of a variable. I've got a little formula that generally results in the average minimum gap size being about 1.5 to 2 points in the ES for me. 65 to 70% of all opening gaps will fill in the same day, and that's important. That's a huge advantage for me, because that means I've got a directional bias going into a trade, an edge, if you will. So I like trading when I know that I've got history on my side. And the other thing is these gaps are driven by traders who are chasing the market normally, and big money doesn't chase. big money, even if the news is legitimate, these big money traders, think Goldman, they'll lose their jobs if they chase a big gap, right? They get paid to buy value. So even if it's legitimately good news that's going to drive, that could have huge impact on the market long term, big money's not going to buy that big gap up that was created on low volume. If anything, they're going to short and try to push as hard as they can to get prices back down to the prior close before then loading up and letting it reverse. So bottom line is gaps have an inherent bias to retracing back to the prior close before establishing whatever trend they're going to make that day and in the coming days. Question is, a couple of questions. I'm going to have to keep moving quickly because I have a lot of content. Outside or inside gaps, depends on what you're trying to do. In general, the inside gaps that open inside of the range of the prior day are common gaps, right? They have a higher propensity, higher probability of filling that day. As a gap fader, I'm trying to fill the gap. I'm trying to catch that move where the price retraces back to the prior close before doing whatever it's going to do. ES futures are the S&P 500 futures. They are highly correlated, 90-some%, 95% with the spider, for example. So if I talk about the ES, just imagine I'm talking about the spider. Assume this does not work on earnings-related gaps in individual securities. Yeah, any outside shocks, that's an extra variable. I will tell you, I've done some analysis with folks on it, though. Most of the gaps are going to still perform with historical odds I show you because that earnings anticipation was built into the numbers. So unless it's just an extremely unusual earnings announcement that catches players off guard, most of the time it's going to conform to historical norms. And yeah, let me keep going through the presentation. I want to make sure everyone's tracking with me here first. These are great questions. I really appreciate them because I love them. Let me just keep going, make sure everyone's with me. So opening gap fade win rates. This is the S&P 500, specifically the spider. Going back, I take that back. This is the ES. This S&P 500 futures, but the spider numbers would be almost identical. Past 10 years have averaged about 225 tradable gaps per year. That's out of 252 trading days per year, and an average win rate or gap fill rate, if you will, of 68%. 68%. So basically 7 in 10 will retrace from their opening price back to the prior day's closing price. So for the ES, since the ES, the S&P futures do trade through the overnight, almost 24 hours a day. Now, I ignore the overnight and pre-market. That's exactly right, James. So I just act as if it didn't happen. I'm watching it. I'm watching the futures to see where price action is, but it's the overnight, that overnight move on light volume that's setting up my trade. So I'm only trading the regular trading hours between 9:30 and 4. So since 70% fill, then obviously it must be an easy trade to make money at, right? Not so fast. Markets are too efficient. In fact, one key thing I want to show you here is I mentioned the 68% of all gaps filled the day they're created, right? Well, a lot of traders like to target half gap fill because that's what their educators are teaching them. Very high probability trade. That's absolutely right. 78% of all gaps will go all the way. But where's the flaw in the logic? The flaw is this isn't a game about win rate. Win rate is just part of the equation on how you make money. We're trying to make money first and foremost. So think of it this way. If 78% fill halfway and 68% fill all the way, that means 85% that filled halfway will go all the way. Or said differently, for a very small decrease in win rate, you can double your profits. So the formula that, in fact, the only formula that truly matters, in my opinion, for trading or traders is called expectancy, right? What's the probability of a winner and the size of that expected win minus the probability of a loss and the size of that expected loss. And if you do a calculation, you'll clearly see, and hopefully it's very logical to you, that for only a small reduction in win rate, you're going to double your average size win, which means you're going to make a lot more money holding for gap fill in almost all scenarios. Does that make sense? You could scale out a bit at 50%. There's nothing wrong with that. You're just leaving money on the table if you like to leave money. And I'm being a little bit tongue-in-cheek here. I will say the one scenario in which I will target half gap fill is on a larger gap. For me, I use 40% of the 5-day average true range. 40% of the 5-day average true range. And if it's anything more than that, then I start thinking about possibly going for half gap fill. I use the research I'm going to show you tonight assumes the gap was at least 10 cents, which is a very small gap in the spider. We haven't had many of those lately. Well, actually today was a small one, but to be calculated these formulas for the ES, it was at least a 1 point in size, I believe. So what's the optimal stop size? Right, so clearly this is just a game of trying to get the right stop size and you can make money, right, with a 70% win rate. Well, not so fast. In fact, what this shows is it doesn't matter how you set your stops. Stops are not the answer. You can use number of points. You know, the bigger your stop going down, I've been told my marker is not lining up very well, so maybe I can, I don't know how to point. I don't have a mouse. Sorry about that, guys. Maybe it's a laser pointer here. The points, the bigger your stop, the higher your win rate. But your profitability doesn't change. Can y'all see my little laser pointer? Does that help? Okay, good. What if you use stop as a percentage of gap size? So if the bigger your stop, again, the bigger your win rate. And the ratio, your win-loss ratio increase is really favorable when you use a tight stop. And it's not very favorable when you use a big stop. But look at this profit factor. If you're not familiar with profit factor, it's a ratio of historical profits to historical losses. I should have clarified that before. It's just your profits divided by losses. So anything around 1 means it's dead break even. Dead break even. You're not making any money. And this is a hard thought for people to get their head around. Even if you use a percentage of the ATR, a volatility-based stop like I use, it doesn't matter. Stops are overrated. And people waste a ton of time and a ton of money trying to optimize and find the right stops. This is not a game of picking the right stop on a given day. It feels like it, right? Because you think you're getting an edge by obsessing over where your stop is, but that's not what this game is all about. Now, a couple comments. I see that someone says the bigger your stops, the bigger drawdown. Not correct. So, but I appreciate the comment. And here's why it's not correct. That's the logical conclusion, right? It's not. What happens, your drawdowns can be comparable. They can be better or worse independent of the stop size, right? If you're getting stopped out a bunch, 7 times out of 10 you're losing 2 points. Well, that's not real different than only getting stopped out 2 times out of 10 and losing 7. The drawdowns are going to be similar. It's really more personal preference is my belief. So in general stops, the bigger the win rate. The tighter, the smaller the win rate. 30% of the 5-day average true range is what I use. And in target, for me, generally is the prior close, the prior session close, and occasionally I'll even go for extended targets. And yes, for Monday gaps, I use I target Friday's close. That's exactly right. So how do you make money? It's all about selection, people. Selection, selection, selection. Select location, location, location. It's all about selection is the key to making money with gaps. So let me take you through the things I look at. Excuse me, the question on risk versus reward with a 30% stop is what I generally use, is a 30% of the 5-day average true range. That varies depending upon the current volatility of the market. Like right now it's around 8 points in the ES. And people will routinely say, holy cow, you use an 8-point stop? And again, I just sort of chuckle. Would you rather use an 8-point stop and average a 6-point win and get stopped out maybe one time out of 3, or use a 2-point stop, average a 6-point win, and get stopped out 80% of the time. It's 6 of one, a half dozen another. It doesn't matter for the equation, expectancy equation. So for me, I have found, for my personality, and many, hundreds of our clients agree, we rather risk a little bit more than we stand to make. And I know that's considered blasphemy if you read some of the classic books. Well, the classic traders didn't have the ability to back test and focus on expectancy. They had to simply focus on strategies that had payoffs greater than the size they were risking, because they could not predict with any certainty. They didn't have the tools that could predict with any certain probabilities that gave them, stack the odds in their favor so they could get away with tighter targets and bigger stops. So for me, I found the psychological advantage of risking a little bit more than I'm targeting is that I rarely have multiple successive losses. It's not uncommon to have 2 or 3 or 4 losses in a row, but I think I've had, in 12 years, I've had 5 consecutive losing trades happen only 3 times. So I know from firsthand experience, and I know from working with others, if you get into a situation where you have 5 or 6 or 7 losses in a row, I don't care how disciplined or how smart you are, you're going to start tinkering with your trades. When money is on the line, you're going to skip a trade. You'll find a convenient excuse to feel a little sick that day, to blame it on the kids, that the kids need to ride to school. You'll miss that trade, and I can guarantee you the trade you skip, subconsciously or consciously, is going to be the big winner that would have erased most of your losses. So having a high win rate keeps your emotional capital preserved, and emotional capital in this game called trading is every bit as important as financial capital. You got to have lots of both. So how do we select trades? Well, I'm going to tell you the ways I select trades. You can select them however you like. Gap size is a good, for gap faders, is a good thing, a good way to measure. You can see the odds here actually favor gaps less than 40% of the 5-day average true range. You can look up ATR if you're not familiar with it. It's just a volatility adjusted measure of basically the range from high to low of a given day, inclusive of gaps. And good win rates, and has made some money if less than 40%. You get more than 40%, then all of a sudden the profit factors go below 1. Remember, 1 is break even, so less than 1 is lost money, except for this tiny bucket down here of the really large gaps. And let me keep going. Yes, I'll show you some stats on what day of the week is best for gap trading. So size is important. Zone is important. This is one of the areas I've gotten some recognition, or just done things a little differently perhaps than others. When I was starting out, I realized the key was fairly quickly that this was a game of selectivity, and I noticed that those gaps that opened beyond the extremes, the highs and lows of a prior session, filled at much lower win rates. And I didn't want to really trade those because I knew psychologically I'd have a tough time. I'm more likely to get caught up in a bunch of losses. But the common gaps, those inside gaps that open inside the prior day's range, had above average winners. Now, just because you have a higher win rate doesn't mean you're going to make any more money either, right? So again, it's about picking the right ones where you can stack the odds in your favor, and where the your average win rate and average size winner is going to be quite a bit more than your percentage of losses and average size loss. So these, don't worry about the number. That's my nomenclature. You can call them whatever you want. U just means the prior day closed higher than it opened, and I use the open, high, low, close, OHLC. So that's if the prior day was an up day. You can see the odds there. That's big delineation for gaps in terms of win rate. And then looking at down gaps, these zones at the extremes, again, a little bit more problematic. DL's not too bad. But this DH zone, prior day down, it opens above the prior high. This is where it opens the next day. That's a less than 50% chance of being a winner. But again, common gaps, the smaller ones around the prior close, are pretty good to trade if you can get a good entry. Before I move on, is everyone with me, or most of you with me, understanding this idea of zones, looking at the prior day's candlestick, taking the high, the open, the close, and the low to segment 5 different opening areas that can occur on a given day? Okay. I know that's a tough thought. If you get confused or anyone has questions later, you can email me, Scott at InvestorQuant. So, but this is a nomenclature I've used for years. It's 10 different zones, very helpful for categorizing gaps and studying them. So what day of the week is best? Well, it depends on if the gap is down or the gap is up. And quite frankly, it depends on the market conditions too, but I'll get to that later. In general, shorting up gaps are the most problematic gaps for trading. It's the riskiest time to short an up gap. Only about a 60% historical win rate. Buying down gaps, and this is over the past 10 years or so, there's a little bit of a bullish bias here for the last 10 years, but even if I went back 20 years, the numbers are not very different. There's some movement though. Wednesdays used to be one of the best days to short up gaps, and now it's still the second best day. But middle week's generally better for buying down gaps, and then Fridays in general are pretty good days. So I don't give a lot of credence to day of week, but I do pay attention to it, especially on Mondays, because the overall average for down and up gaps on Mondays is the worst. So if you're going to take any days off, take off Monday. Don't take off Friday as a gap trader. Question is, do I use zones for targets? No, I'm primarily some people do. There's nothing wrong with that. I target the prior day's close. I just find is the most consistent one for me that has the best expectancy. Another question, well, tomorrow's non-farm payroll news, do you trade gaps? I will trade gaps on just about any day if the market conditions are appropriate. That means, yes, I sometimes get caught up in the volatility of the news, but I'm a big believer that the news, except for the exceptional events where things catch market participants off sides, in general, it's baked into the price action. I found certain days of the week, like jobs report tomorrow, options, or certain calendar events, I should say, jobs report, Fed Day announcements, right, 8 times a year, OPEX Friday, third Friday of every month. Those are special days that have very clear and consistent patterns for trading. Some of them are favorable for fading the gap. Some are very unfavorable for trading the gap. So you really need to know and study those. That's kind of stuff that we share with our members in my analysis. But definitely, good question. It's something you pay attention to. So let's talk candlesticks. I'm going to power through these. Again, you can download these slides at investorquant.com/Bigelow, investorquant.com/Bigelow, and you can get a copy of the slides and my ebook. In fact, I typed this up before, I forgot to hit send. You can email me if you have questions as well. But I'm going to go through 12 candlestick patterns. These are ones I learned from Steve. And it's not the exact 12. When I added up Steve's 12 the first time, I got 16. But I think it's the way I was classifying them. So, and some of them don't have as big a sample sizes, meaning they haven't occurred as much. So I'm going to focus on the 12 that have occurred the most frequently, well, that occur frequently. There's some other ones too. But these are the ones I'm going to go through. I've got slides and research on each one. Dojis in both uptrends and downtrends, they have different characteristics. Bullish engulfing patterns, bearish engulfing, hammer, hanging man, the bullish and bearish haramis, bullish kicker and bearish kickers, and shooting star and inverted hammers. One last question before I get into the research. How can you show the up gap winning percent, please? PD, download the slides. Just go right to that link there and you can have these exact slides, okay? Still there? Or I should say, am I still here? Okay. Thank you. I don't know what that's about. I have a stable internet here. All right, so let's go in some candlestick pattern stats. Let me make sure you understand the assumptions. It is on the spider, the past 15 years, assumes that one faded the opening gaps. If the gap was up or down, either shorted it or bought it. That's the fade. Gap size was a minimum of 10 cents. I'm entered with a market order at the open. Exit at 4 p.m. Eastern Time. No commissions included because I wouldn't trade a given candlestick pattern just because of the candlestick pattern as a gap fader. My analysis is much more robust than that. This is meant to give you a directional bias and an edge. Whether you're a swing trader or an intraday trader, I think this information can help you out. And again, I use profit factor, which is a ratio of profits divided by losses. James says, any information on sector spiders? Not in this presentation, but I have done a lot of research, and actually every day I publish gap fill probabilities for each of the Amex select sectors you mentioned right there. XLB, XLE, XLF, industrials, utilities, consumer staples, XLP, all of them published every day on our website. And for those of you that are candlestick traders with Steve, that's just a huge advantage because you get the best of both worlds, right? You get a world-class chart technician, is how I think about Steve, with world-class probabilities, historical predictive analytics, as we say. And the traders that I work with and that are members of ours, that have been members for years, that are the most successful, are the ones that combine both. So here's the doji. I'm just going to point out some highlights. You can go back and study these on your own. And shorting up gaps has been the better trade when you have a doji candlestick and you're above a 10-day moving average. And I'm just using the 10. I probably should have used the 8 EMA, but I did this similar presentation a few years ago for Steve and his clients, and I had the 10 set up then. It was just easier for me to rerun the analysis again. And I use a 10. I know Steve likes his T-line. Nothing wrong with that. But this data is based on the 10-day moving average. And it generally favors shorting up gaps. So this is a sign of indecision. Maybe time for a pause. So you get an up gap. I love shorting up gaps after a doji in a bull market. Down gaps are not terrible either. They're just neutral overall. This is the 10-period daily moving average, a simple moving average. Gerald, download the slides. Can't write them down. I'm not sure. So pretty much the most important information is contained here. And Steve asked me to get through the bulk of the slides in 45 minutes. I'm already a little bit behind. So let me keep going here, okay? And if you have any questions, just shoot me an email, Scott@InvestorQuant. If below the 10-day moving average, the opposite is true. Buying down gaps has been the better trade historically, just as I've circled and highlighted for you. So buy down gaps. So the market's showing a little bit of indecision. A gap down is a good opportunity to trade the gap. Now, this does not include any intraday stop. This assumes you held to the end of the day. So this is a spider. So you're using an end-of-day stop. That could, you could be taking on a fair amount of risk there. I'm not suggesting that, but this is showing the odds of gap fill by the end of the day on a down gap. Down gaps are definitely favored. Up gaps, just more neutral. Bullish engulfing pattern. Now this one is a little bit different than I ran it a few years ago, and from my understanding on when Steve looks for, and many of you probably look for these engulfing patterns, bullish engulfing patterns are often spoken about in the context of a potential reversal signal after weakness. They just don't happen much during a weak market, meaning when below a 10-day moving average. It's like a third of this. So I thought out of curiosity I would run them to see what bullish engulfing patterns look like the next day when above the 10-day moving average, and these odds were interesting. Basically, you expect consolidation. You're in a bullish market, you get an engulfing pattern. If you gap down the next day, odds are it's going to make it back to the prior day's close at a minimum. If you gap up, odds are it's going to come back and test it as well. So it's just a good mean reverting pattern to look for. And these are daily candlesticks that we're looking at here. Thank you for the question. Anyone with audio issues, it really just depends on your connection over the internet to the platform. Sorry, nothing I can do about it. The recordings normally come out clean. Bearish engulfing pattern, also a pretty darn good setup, uh, regardless, especially for down gaps. So while this looks weak, you're in a weak market and it has an ugly candlestick, the fact that you did have some strength in the morning because it opened up and following a green candlestick, but then it couldn't hold it together, that's a sign that bulls will start, in my opinion, that's a sign that bulls are starting to dip the toes into the market. So if you gap down the next day, it's got a good win rate, and the bigger moves have been back to gap fill. So don't shy away from down gaps after a bearish engulfing pattern during a weak market. Hammers, the old, I call them hammer sticks, the hammer candlestick. Uh, I That's pretty clear to me looking at the profit factor. This tells you that bigger moves have been to the long side because it's lost money shorting up gaps. So fading up gaps has lost money. But buying down gaps has made money. So that's a clear long bias, regardless of which way you gap. So a hammer does indeed point to hammering out a bottom after weakness. Hanging man, it too is actually somewhat bullish. In fact, down gaps are very bullish after this pattern. Bulls stepped up and drove things higher after some weakness, and they're likely to step up again if you gap down the next morning. Again, 80% odds has made more money than it's lost. The bullish Harami is indeed bullish. Check these stats out. Those are really strong odds. Profit factor of 2.3, that means it's made $23 for every dollar it's lost. Correction, every $10 it's lost. So more than double the profits from the winners than the losses here. Whereas shorting up gaps is very dangerous. So you see a bullish Harami pattern, red candlestick with an inside green candlestick. You got to be real careful shorting that. You're going to have some speculative buyers stepping up to drive things higher. It's a dangerous short, but a great looking buying opportunity the next day. And vice versa, the bearish Harami is indeed bearish. It absolutely works. Again, this is on the spider for the past 15 years. So each of these patterns individually may not occur real frequently, but when they do and you can recognize them, man, that's a gift. I track a lot of these in our database because it is hard to keep up with them, but these are gifts. They give you extra confidence when they line up. So after a bearish Harami, if you happen to gap up after this 2-day pattern, you gap up here, don't be afraid of it. It's likely to come back and fill the gap. And if you gap down, that one you should be afraid of. So this is not the time to buy a dip. When you get a bearish Harami, I would not do it. 58% win rate's not bad, but it's lost money. All right, bullish kicker is just like you might think, bullish. Okay, so a down gap, it's neutral if you get a down gap, but shorting an up gap is another dangerous scenario here. That green candlestick after a red candlestick, watch out. 50-50 odds. Bearish kicker, now this is interesting. It's really not as bearish. It actually, historically, whether we gap up or down after this, has been a good setup. I'm not exactly sure why, but it's gone too far too fast and buying a down gap. It is a small sample size. Let's keep that in context. That's a small sample size of only 15 trades, but 12 are wins. And vice versa, if we shorten up gap, it's probably going to have some more weakness the next day. So look for a mean reversion bias. Shooting star, almost at the end here. Shooting star, this was surprising in that it didn't happen more. I thought this was a more frequently occurring pattern, but it has not been in the spider. And it really doesn't give us a whole lot of insight other than it does appear to have a bit of a short bias the next session, which is what you would think. The question is, would the gap trade come after the two colored bars? Yes. So all of these stats are what happens after this candlestick. It's the next morning's open. after this pattern. And if you get an up gap or a down gap, this simply shows the odds for fading the open and price action retracing back to that prior day's close. Inverted hammer, that is a weak setup. So if you're below the 10-day moving average, you get an inverted hammer, and you get a gap up, that's a gift. You ought to consider shorting it. If it's a down gap, watch out because the bigger moves have led to more selling, as evidenced by a profit factor of only 0.5. So the losses have been twice as big as the winners. So that's a short bias. And again, I've got the takeaways here. So that's a quick run through in candlesticks. I'm going to have to power through, folks. Again, you can listen to the recording later, which will be clean. And you can download the slides by going to investorquant.com/Bigelow. Couple more tips here, and then I'll wrap it up and answer any questions I can. Selection has several components to it for me. I showed you some of the things I look at. I look at seasonality or day of week. I pay attention to calendar considerations. I do pay attention to special days. I pay attention to the size of the gap and the zone that it's in. But that's only a one-dimensional view. I guess you could argue it's a two-dimensional view, but that's just one layer. You really need to go one more additional layer of analysis down, which is to look at that particular pattern, that candlestick or zone or the combination of those things under similar historical market conditions. It's all about the market condition. A doji in a raging bull market is going to act very different than a doji in a weak bear market or a raging bear market or a weak bull market. And that's why I was showing some of those stats I just showed you in candlesticks was specifically tied to above or below the 10-day moving average. Because if I showed the odds on the other side of the moving average, you wouldn't even recognize them. They're very different. So if you look at dojis in general, it's a very homogenized setup. If you look at it in the context of specific market conditions, that's when you start seeing a big difference. So for me, I don't have time to get into these, but I have organized all of my research over the years into 5 core systems for trading the gap. I actually have 8 systems, but 5 main ones that are market condition based. I look at the trend, I look at the momentum, I look at the volatility, I look at whether we're overbought or oversold. That's basically Bollinger Bands, different percentiles of standard deviations, and seasonality. And then I take all of these things I talked about in the course of this presentation. I look at how have Mondays done under similar trend considerations, trend conditions. How has the UH zone or large up gaps done under similar states of momentum or volatility historically? So I break it down with a more of a 3-dimensional look or analysis. And frankly, that's been the whole key to me consistently being in the market over the years. So the missing piece in the puzzle where most people stop, they'll look at individual pieces of data like I talked about, but that's just not enough. When you do it in the context of appropriate market conditions, now you're onto something. And quite frankly, this is a really robust and proven predictive analytics approach called ensemble forecasting. You don't need to know the name, but it is. It's useful. It's what's used in predicting political elections, weather forecasting, which maybe isn't a great example, I admit, retail sales, you name it. You take a lot of very good systems, take the average of them, and they're going to outperform a singular best system over the long term every single time. And that's what I do. So super quickly, then I'll open up to questions. InvestorQuant, it's a company that I started, merged with Rob Hanna's Overnight Edges, a world-class statistical guru, market guru, and we have combined our services with Master the Gap and Overnight, added a swing component. We now serve intraday, overnight, and swing traders. We have collaborated with Duke University's Center for Quantitative Modeling. They've helped us out and validated our research. We expanded to hundreds, have research now, not just on the symbols I trade, but almost 300 different instruments, ETFs, commodities, equities, NASDAQ 100, S&P 100. We have hundreds of members that have been subscribing, and that means paying, not free subscription, paying subscribers for more than 2 years, actually more than 3 years. And that's probably the best testament I could tell you about our business. And we have 6 full-time traders in our team also. Well, we work and we use our own research, but we have a ton of trading experience on our team. So we'd love to help you out. If you're interested in learning more, go to investorquiet.com/Bigelow. You can get my book. These beautiful slides that I had some help with, to say the least. And you'll also get auto-registered. You can unsubscribe if you want for a webinar. I'll tell you more about and show you my actual research and how we slice the market up each day and trade the opening gap and ranges and other cool techniques as well. So what questions do you have for me? Sorry I had to rush there so fast. Yeah, I think we found it a little bit too cumbersome to take the 40 slides and combine them with the book. So there's 2 links there. You can link to either one when you go there. Why didn't win fall? Jacob, here's my view on trading. My historical win rate has been on gap trading has been 65%. The highest I've ever had in a given year was 69%. The lowest was 60 point some percent, so basically 61%. The way, and I'm trading with just pure historical probabilities. I'm not using charts and indicators or anything like that. The using historical predictive analytics is helpful 2 times out of 3. 1 time out of 3, the market is going to be influenced by outside pressures that can be caused by any number of factors, and you just can't predict them. And I've just generally accepted. I've worked with a lot of statisticians, a lot of other world-class traders, and they all say the same thing. You're just not going to find an edge that works more than 70% of the time. There's just too many outside pressures in play. Oh, good. I'm told I can go a few minutes over tonight, so I can take a breath. Great. Thank you, Jim. I'm trading off 5-minute charts is what I'll look at intraday. You can really use anything. In fact, I've traded from vacation off of the back deck staring at the beach without any charts. I've traded from convenience stores and driving down the road to gas stations and just calling in orders based upon simply knowing where a price was. So I don't really need a chart. But like I said, the people that have done the best with my service over the years tend to have some chart reading skills and combine it with our decision support tools, which is the way I think about our analytical data. You could do really well. Are news-based gaps better than the rest? That's an interesting question. I treat them the same, so it doesn't really matter. The news-based gaps make me a little more nervous because I don't know which ones. I have a decent idea these days on which ones are going to be noise and be good trading opportunities versus which ones are going to potentially cause a sustained reaction. Jobs report can cause a sustained reaction. Fed day can cause a sustained reaction. I'll tell you the ones I like. If a company, one other than maybe an Apple, a big company announces earnings, but Intel or somebody, and they miss their numbers, and it drags the whole market down, and that's the whole market's gapping down, or vice versa, gapping up because they blew out numbers. I love it when there's a single market that sort of puts everyone in a good mood and lifts everything, because those are normally good fading opportunities, because a single piece of news based on one company, even the biggest ones, is really going to sustain the entire S&P 500. Mohammed asks, when fading, just enter the open or only after it starts moving in your expected direction? I enter at the open, and again, that's a little bit contrary, but I've done this a long time, and I found it works better for me because I catch all the winners. So when I believe I have a good quantified setup that I've done my robust analysis on, and I believe there's an edge and the odds are stacked in my favor, if I wait to try to get a better entry, the profits I lose from the trades that just run away and fill the gap immediately are more than cost me more than the extra point or two I may have gained by entering on a delayed basis. So I enter when the historical analysis lines up. Now that said, you don't have to do it that way. I certainly know I have clients that enter at the close of a 5-minute bar and they use what happens in that 5-minute bar to guide them, but to me that's just too hard and unnecessary. Plus it's been nice if you could provide some example charts. Sure. What do you want to? I've got some examples early in the slides, but I can pull up. Actually, I've got. I don't know if I can. I'll tell you what. Come to the presentation on March 10th. That's mentioned here, and I will show lots of examples, real trade examples that I've taken recently, not a long time ago, recently. I'm having a tremendous start to the year, almost too good to be truthful. And I know that may sound odd, but if anyone that's followed me for a long time, I do daily videos, and you've heard me whine. I go through, and I just showed you my equity charts, my own trading over 2,000 trades. I've had lots of drawdowns, okay, but I'm off to a really, really good start. Over 75 gap trades already, actually pushing close to 100 now in the first 2 months. But I'm trading multiple markets, and I've got most of my strategies automated now. But I've actually just manually executed all my trades until the past few months. So for 10 years, those 2,000 trades are almost all manually executed. Once you download the book and the slides, you'll be automatically registered for the webinar, and you can unsubscribe if you wish. Al says, do you short them on the way down as they gap? I do not add to my position. I know a lot of people believe in that. I just have a hard time with it. I make a very binary decision to enter at the open. I'm either buying a down gap or shorting an up gap if it meets my criteria. I've set my target at gap fill, and I have my stop on the other side of my entry and with a bracket order, and I leave it alone. It's either going to hit my target or hit my stop, or I will close it at the end of the day, which only happens maybe 2 or 3% of the time. Are indices more predictable and stable or consistent than individual equities? Yes, Joe. Now here's the interesting thing. Indices work, they have that mean reverting bias because big money's trading them, and it's really hard for a single piece of news to sustain an opening gap without filling it for the entire broad basket, right? But a single stock can easily have a single piece of news, especially earnings related, as someone mentioned before, that's going to keep it from filling its gap that day. So what happens, I find them less predictable. That said, you can study the different sectors and see which sectors are trading with the highest gap fill win rate in a given month or quarter and focus on those stocks. And you can have, I've seen traders have 80 and 85% win rates doing that. To me, it's a little bit more work than I want to do, and I like to trade the S&P index futures. James, we're just a subscription research service. We have a pretty robust offering from strategy creation tools, trade selection, and identification tools, and we're starting to roll out auto trading tools as well. I don't want to really make this a commercial right now. My style is to educate. Come to the webinar next Thursday, March 10th, as shown on the slide, and I'll tell you all about it. David says, can you go over the gap zone as a good selection criteria slide one more time? Yeah, that's the toughest one to understand. Oh, I appreciate the nice words, folks. How did I trade the market today? The gaps were small, so I did no trades on the gap. I took a 15-minute range trade on the ES. So if you go to my website and look at free research, you'll see my last video. I do a daily video and I review what happened. I have a daily tip. I did a 15-minute high fade, so I went short when we tested the high of the 15-minute range and made right at 6 points, or about $300 per contract. The going back to the gap zones. So gap zones, there's 10 of them total. It's based on whether the prior day closed up, in this case like it shows here, or did the prior day close down. So if the day closed up like it did today, these are the zones that are in play tomorrow. If we gap above and open above today's highs tomorrow morning, then it's going to be what I call a UH zone. It's only had a 60% winner. If it opens between the high and the close, and I don't remember, I don't know that we had a lot of room between the high and the close today, but that's a high probability trade. If we opens between the close and the open, 76% odds. That's just broadly speaking. If we happen to gap down below and open below today's lows, I call those blood gaps, below the low of an up day, below the low of an up day, and they are risky because you end up picking up short sellers and you got folks that have to cover their longs, so they sell to cover and close the position. If you go, if you look at down gaps, the prior day closed down, you had a red candlestick, and then you gap up the next day, you can break it down again by the high, the open, the close, the low, and again you can see how the odds delineate there. Oh, I really appreciate the nice words, Richard, and everyone. Oh, Matt's posted a link to my video today. Thanks. Mooney says, suitable for my markets, any course is there? I'm not sure I know what you mean. Most of our support and training is done with memberships, Mooney, and these webinars that I do from time to time. Trade Seeker says, do I still use candle zones to decide whether to fade the gap? So I've got 5 systems that are based on market conditions that I showed in the presentation today, Trade Seeker. And I've got 3 systems that are based on the zone. So I actually have 8 total core systems that I use to evaluate. Now that sounds like a lot, and it is, but that's why our clients encouraged me to build this company and take our systems and automate it. So, and I started a technology company a long time ago, so I'm not a techie per se, but I know a lot of smart developers. And so I've got a nice, fantastic team, and we've automated these systems and rolled them up into a nice, simple visual cue that tells you whether or not the probabilities are in your favor or not. So yes, gap zones are a big part of what I still use. Question from FH, how do I find gaps quickly that open? Do you follow many stocks? You know, FH, I don't. As I mentioned before, I prefer to trade the indices. I focus on the S&P, the Dow, Russell, and NASDAQ. We've got a scanner, we call it Radar, IQ Radar, that our members use for identifying the best gap setups for the NASDAQ 100 and the S&P 100 using my same systems I just mentioned. JD says, over time, do all gaps get filled? JD, there's one thing I can say with 100% conviction, is that when you die and I die, there will be gaps that have never filled and probably never will fill. So you can go back on a chart and tempted, but it's late here, to open up my charts. Next week, join me, and I'll go into my charts and show you. But I've got an indicator that shows all the unfilled gaps, and I've got unfilled gaps going back for 10 years. So I used to try to use that for swing trading. It is not a good swing trade tool. I will say, in general, the average, last time I tested, and it has been a few years, average gap gets filled in about 10 days. So not nearly as quickly as you think. If a gap is not filled today, don't expect it to fill the next day. Those odds are extremely low. See, I used to know it off the top of my head. So if a gap doesn't fill on a given day, I think you've only got about a 20 or 25% chance of it filling the subsequent day. That means odds are 75, 80% chance it's going to continue in the direction of the gap, which I know a lot of you are swing traders. And when you see those unfilled gaps, absolutely, you want to be thinking the swing bias, at least for the coming days, is away from that unfilled gap. Paul says, are you you prefer to close 16:15 Central Time and open at 1700 on 9:30? Yeah, Paul, I'm for the S&P futures. I'm ignoring the overnight session. I use the 9:30 a.m. Eastern Time open and the 16:15 Eastern Time close. 9:30 Eastern Time open, 16:15 Eastern Time close. All right, folks. I have overstayed my welcome here. Steve, thank you very, very much. Jim, Becky, everyone. And I do hope that people have gotten some value from today's presentation. It's not the only way to trade, but it's worked really well for me for a long time. And I think predictive analytics, like I've shown here, can spice up and improve most people's trading plans. And hopefully you'll download the slides and come check us out next week. Y'all take care.